There is a silent battle happening inside every trader's mind. It is not a battle against the market. It is not a battle against institutions, algorithms, or economic news. It is a battle against fear, doubt, hope, greed, and uncertainty. Most people enter the financial markets believing success comes from finding the perfect strategy. They spend years searching for magical indicators, secret patterns, and winning systems. Yet even when they discover strategies that work, many still lose money. In Trading in the Zone, author and trading psychologist Mark Douglas reveals a powerful truth that changes everything. The greatest obstacle to success is not the market. It is the trader's own mind. The book begins by exposing a painful reality. Most traders carry emotional baggage into every trade. They fear losing money. They fear being wrong. They desperately want certainty in a world where certainty does not exist. Every time they place a trade, they unconsciously seek validation. They want the market to tell them they are intelligent, capable, and right. But the market does not care. The market has no emotions. It does not know who you are. It does not reward hope and it does not punish fear. It simply moves according to countless forces operating at every moment. When traders expect the market to behave according to their desires, disappointment becomes inevitable. Mark Douglas explains that successful trading begins when a trader accepts uncertainty completely. This idea sounds simple, but emotionally it is one of the hardest lessons anyone can learn. Human beings naturally seek predictability. Since childhood, we are taught that hard work should produce results, that preparation should guarantee success, and that being right deserves rewards. Trading destroys these assumptions. You can make a perfect decision and still lose money. You can follow every rule and still experience losses. You can be completely correct about market direction and still be stopped out before the move happens. For many traders, this feels unfair. The emotional pain comes from confusing individual outcomes with overall probabilities. A casino owner understands this principle perfectly. When a player sits at a blackjack table, the casino does not know whether that specific player will win or lose. Yet the casino confidently continues operating because it understands probabilities. Over thousands of hands, its edge produces profits. Great traders think exactly the same way. They stop focusing on individual trades. Instead, they focus on their edge over a series of trades. They understand that any single trade can result in a win or a loss. What matters is the long-term consistency of execution. This shift in perspective changes everything. Imagine carrying the emotional burden of needing every trade to work. Every market movement becomes stressful. Every loss feels personal. Every mistake feels devastating. Fear begins influencing decisions. Traders hesitate when they should enter. They exit early when they should stay patient. They hold losing positions hoping the market will reverse. Now imagine approaching trading like a casino owner. You know your edge. You know some trades will fail. You know losses are simply part of the business. Suddenly, fear loses much of its power. Mark Douglas emphasizes that consistency is impossible without accepting risk fully. Most traders claim they accept risk, but their actions reveal the opposite. When a trade moves against them, panic appears. When losses accumulate, frustration grows. When profits disappear, anger takes control. These emotional reactions prove that the risk was never truly accepted. True acceptance means being emotionally comfortable with the possibility of losing before entering the trade. Not after. Before. This concept separates professionals from amateurs. Professional traders understand that uncertainty is permanent. They never demand guarantees from the market. They simply execute their plans and allow probabilities to unfold. The book then explores one of the most destructive habits in trading, the need to be right. For many people, being wrong feels painful because it threatens their identity. Society often associates mistakes with failure. As a result, traders unconsciously defend their opinions instead of responding objectively to market information. A trader buys a stock expecting it to rise. Instead, the price falls. The market is delivering new information, but the trader ignores it. Why? Because accepting the loss would mean admitting the original opinion was wrong. Ego becomes more important than reality. The trader holds the position longer. Losses grow larger. Hope replaces logic. Eventually, the small loss becomes a catastrophic one. Mark Douglas argues that successful traders detach their self-worth from trading outcomes. They do not need the market to confirm their intelligence. They do not need every prediction to be correct. Their confidence comes from discipline rather than accuracy. This is a profound shift. Most beginners believe successful traders are right most of the time. In reality, many successful traders win less than half their trades. Their success comes from managing risk and allowing winners to outweigh losers. The market rewards discipline, not perfection. Another powerful lesson in the book is understanding beliefs. Every trader develops beliefs about the market based on past experiences. These beliefs influence perception. Two traders can observe the exact same chart and reach completely different conclusions. Why? Because they are not seeing the market objectively. They are seeing it through the filter of their beliefs. If a trader recently experienced several losses, fear may dominate perception. Every opportunity appears dangerous. Every setup seems questionable. If a trader recently enjoyed several big wins, overconfidence may dominate perception. Risk seems smaller than it actually is. Warning signs become invisible. In both situations, emotional bias distorts reality. Douglas explains that successful trading requires creating empowering beliefs that support objective decision-making. Traders must believe that anything can happen. They must believe that every moment in the market is unique. They must believe that outcomes are probabilistic rather than certain. These beliefs create emotional freedom. Without emotional freedom, consistent execution becomes impossible. One of the most memorable ideas in the book is the concept of thinking in probabilities. Most people think in terms of certainty. They want guarantees. They want predictions. They want confidence that a trade will succeed. The market refuses to provide these things. Instead, it offers probabilities. A setup may have a historical advantage. It may win 60% of the time. That does not mean the next trade will be a winner. It simply means that over a large sample size, the edge should produce favorable results. Accepting this truth removes enormous emotional pressure. Traders no longer need to predict every market movement. They only need to execute their edge consistently. The beauty of this mindset is that it transforms losses. Instead of viewing losses as failures, traders begin viewing them as business expenses. A restaurant owner does not become emotional because ingredients cost money. A store owner does not panic because inventory must be purchased. Likewise, traders should not become emotionally devastated by normal losses. Losses are part of the process. They are the cost of participating in opportunities. When this understanding becomes deeply internalized, confidence grows naturally. Not the fragile confidence that depends on winning, but the durable confidence that comes from trusting the process. Douglas repeatedly reminds readers that consistency starts with self-discipline. Markets constantly tempt traders to abandon their plans. Fear encourages hesitation. Greed encourages overtrading. Hope encourages holding losers. Impatience encourages entering weak setups. Every trading day becomes a test of emotional control. The successful trader is not necessarily the smartest person in the room. Often, the successful trader is simply the most disciplined. They follow their rules when emotions scream otherwise. They remain patient when opportunities are absent. They accept losses gracefully. They avoid revenge trading. They trust probabilities. Most importantly, they protect their mental state. Because once emotions dominate decision-making, consistency disappears. By this stage of the book, a powerful realization begins emerging. Trading is not primarily a financial activity. It is a psychological activity. Charts matter. Strategies matter. Risk management matters. But psychology determines whether those tools are used effectively. Two traders can possess identical strategies. One becomes consistently profitable. The other continues losing. The difference is often mindset. One accepts uncertainty. The other fights it. One follows probabilities. The other seeks certainty. One manages emotions. The other becomes controlled by them. Mark Douglas's message is both challenging and liberating. The market does not require perfection. It does not require extraordinary intelligence. It does not require predicting the future. It requires emotional discipline. It requires acceptance of uncertainty. It requires confidence in probabilities. And above all, it requires the courage to think differently from the crowd. When traders finally stop trying to control the market and start controlling themselves, everything changes. Fear begins fading. Clarity begins emerging. Decisions become simpler. Execution becomes smoother. The trader enters what Douglas calls the zone, a mental state where actions flow naturally, emotions remain balanced, and probabilities are trusted without hesitation. In that state, trading is no longer a desperate struggle against uncertainty. It becomes a calm, disciplined process guided by confidence, patience, and self-awareness. And that transformation, more than any indicator or strategy, is what ultimately separates consistent winners from everyone. As the lessons of trading in the zone continue to unfold, Mark Douglas takes the reader deeper into the hidden psychology that quietly destroys most trading careers. By this point, it becomes clear that markets are not merely testing a trader's strategy, they are testing the trader's emotional stability. Every day, the market acts like a mirror. It reflects fear back to fearful people. It reflects greed back to greedy people. It reflects impatience back to impatient people. The market exposes every weakness that exists within the human mind. This is why trading can feel so emotionally exhausting. It is one of the few professions where a person's beliefs, fears, hopes, and insecurities become visible almost immediately through their decisions. Douglas explains that most traders unknowingly create emotional pain because they attach meaning to every market movement. A small price fluctuation suddenly becomes a judgment about their intelligence. A losing trade feels like proof that they are not capable enough. A winning trade becomes evidence that they are finally good. This emotional roller coaster is dangerous. When self-worth becomes connected to trading results, emotional stability disappears. A profitable day creates excitement. A losing day creates depression. A winning streak creates overconfidence. A losing streak creates self-doubt. The trader becomes trapped inside an endless cycle of emotional highs and lows. Professional traders learn something different. They separate themselves from outcomes. They understand that outcomes are uncertain, but their behavior remains under their control. This distinction is powerful. You cannot control the market. You cannot control economic news. You cannot control unexpected events. But you can control your preparation. You can control your risk. You can control your discipline. You can control whether you follow your plan. When attention shifts from outcomes to process, emotional pressure begins to disappear. Douglas describes how many traders become addicted to certainty. They spend years searching for systems that never lose. They jump from indicator to indicator, from strategy to strategy, believing the next method will finally eliminate uncertainty. But uncertainty can never be eliminated. It is built into the market itself. The moment traders accept this truth, they stop wasting energy on impossible goals. Instead of searching for certainty, they begin developing confidence. And confidence is very different. Certainty means knowing what will happen. Confidence means being comfortable even when you do not know what will happen. This is the mindset of successful traders. They enter trades without demanding guarantees. They accept risk without fear. They allow probabilities to work over time. Douglas compares this mental transformation to learning how to trust yourself. Most traders trust the market more than they trust their own process. They constantly seek reassurance from news headlines, social media opinions, analysts, and other traders. Every decision becomes dependent on external validation. But consistent traders develop internal trust. They trust their rules. They trust their edge. They trust their risk management. Most importantly, they trust themselves to handle whatever happens next. This trust creates emotional freedom. Without emotional freedom, every trade feels heavy. With emotional freedom, every trade becomes just another opportunity. The book then explores one of the most dangerous emotional traps in trading: fear of missing out. Every trader has experienced it. A stock suddenly starts rising. A market begins moving rapidly. Profits appear everywhere. The trader feels an overwhelming urge to participate. Logic disappears. Patience disappears. Discipline disappears. The fear of missing an opportunity becomes stronger than the desire to make good decisions. Douglas explains that this emotional reaction occurs because traders focus on scarcity rather than abundance. They believe opportunities are rare. They believe this trade is special. They believe they must act immediately. Professional traders think differently. They understand that opportunities never stop coming. The market opens again tomorrow. New setups will appear. New trends will develop. New opportunities will emerge. Because they believe in abundance, they feel no urgency to chase. They wait. They remain patient. They allow opportunities to come to them. This patience creates a tremendous advantage. The emotional trader constantly reacts. The disciplined trader responds. The difference may seem small, but over hundreds of trades it becomes enormous. Douglas also discusses the emotional damage caused by expectations. Expectations sound harmless. In reality, they often create suffering. A trader expects a trade to move quickly. It doesn't. Frustration appears. A trader expects a breakout to succeed. It fails. Anger appears. A trader expects a profitable week. Losses occur. Disappointment appears. The problem is not the market. The problem is the attachment to expectations. Markets do not owe anyone specific outcomes. When expectations disappear, emotional reactions weaken. Traders become more flexible. They become more objective. They become more capable of adapting to changing conditions. One of the most profound ideas in the entire book is the concept that every moment in the market is unique. At first, this sounds obvious. But most traders behave as if current trades are connected to previous trades. After several losses, fear increases. After several wins, confidence increases. The emotional baggage of the past begins influencing present decisions. Douglas argues that every trade should be treated independently. The market does not know your previous results. It does not care about yesterday's profits. It does not care about last week's losses. Each opportunity exists on its own. When traders truly understand this principle, emotional baggage loses its influence. A previous loss no longer creates fear. A previous win no longer creates overconfidence. Each trade receives the same objective treatment. This is the foundation of consistency. Consistency does not come from predicting the future. It comes from responding to opportunities in the same disciplined manner regardless of recent outcomes. Douglas emphasizes that beliefs create reality. If a trader believes losses are painful and threatening, losses will generate fear. If a trader believes losses are normal business expenses, losses become manageable. If a trader believes mistakes define personal worth, mistakes become emotionally devastating. If a trader believes mistakes are opportunities to learn, growth becomes possible. The market itself does not create emotions. Beliefs create emotions. This realization gives traders tremendous power. They may not control the market, but they can choose their beliefs. And changing beliefs changes behavior. As the book approaches its most important lessons, Douglas introduces the mindset that truly defines great traders. Great traders are not focused on making money. This statement surprises many readers. After all, isn't money the goal? Of course, money matters. But focusing directly on money often creates emotional problems. Fear of losing money causes hesitation. Desire for money causes greed. Obsession with money causes impatience. Great traders focus on execution instead. They focus on following their process perfectly. Profits become the byproduct of excellence. Just as elite athletes focus on performance rather than trophies, elite traders focus on execution rather than profits. This shift changes everything. Instead of asking, "How much money can I make today?" they ask, "Can I execute my edge flawlessly today?" Instead of measuring success by profits, they measure success by discipline. Ironically, this mindset often leads to greater profits because emotions interfere less frequently. Douglas ultimately guides readers toward a state of mental clarity that very few traders ever achieve. In this state, fear no longer dominates decisions. Greed no longer controls behavior. Losses no longer create emotional devastation. Wins no longer create dangerous overconfidence. The trader becomes calm, focused, patient, disciplined. The market remains uncertain, but uncertainty is no longer frightening. It becomes accepted, even welcomed. Because uncertainty is what creates opportunity. Without uncertainty, there would be no market. There would be no profits. There would be no edge. The final emotional lesson of trading in the zone is beautifully simple. Success is not about conquering the market. Success is about conquering yourself. The charts will always move. News will always change. Prices will always fluctuate. Uncertainty will always exist. But traders who master their minds gain something incredibly valuable. They gain consistency. They gain confidence. They gain emotional freedom. And in a profession where most people spend years fighting the market, they discover the secret that changes everything. The greatest edge was never on the chart. The greatest edge was within themselves all along. 9.